For years, JPMorgan Chase, led by its famously crypto-skeptical CEO, Jamie Dimon, has been the face of Wall Street's old guard, often dismissing Bitcoin. But a new SEC filing just revealed a stunning pivot. JPMorgan has boosted its holdings in the BlackRock Spot Bitcoin ETF, IBIT, by a colossal 64%. We're not talking about a tiny experiment anymore. We're talking about America's largest bank, with trillions in assets, officially and substantially increasing its exposure to the very asset its leadership once derided. This isn't just a news story, it's a tectonic shift in institutional confidence. Today, we're diving deep into the $343 million position, what the 13F filing really means, and most importantly, what does this massive, 64% institutional influx signal for the price of Bitcoin in 2025? Stay tuned, because the numbers from JPMorgan's own research team suggest a price target that might surprise you. Hit that like button, subscribe for your daily dose of crypto intelligence, and let's get into the data. Let's start with the hard numbers. This information comes from a required 13F filing with the US Securities and Exchange Commission, SEC. This document gives us a snapshot of what institutional investment managers, like big banks, hold in their portfolios. The filing shows that as of the most recent reporting period, JPMorgan is holding approximately 5.28 million shares of BlackRock's iShares Bitcoin Trust, or IBIT. This position is currently valued at around $343 million. The headline-grabbing number is the increase. This represents a 64% boost from their previously disclosed holdings. Initial holding, approximately 3.2 million shares. Current holding, approximately 5.28 million shares. Growth, a 64% leap in share count. Now, a crucial point of clarification: when a massive financial institution like JPMorgan files a 13F, these holdings don't necessarily represent the bank's proprietary balance sheet. This is an aggregate number that includes holdings for their high net worth clients, their asset management division, and, importantly, the positions they hold as authorized participants, APs, or market makers for the ETF itself. However, dismissing it as just market making misses the forest for the trees. The significance of the market maker role. The role of an authorized participant is to create and redeem ETF shares to keep the ETF's market price in line with its net asset value, NAV, the price of the underlying Bitcoin. They are the liquidity providers. But here's the kicker: for JPMorgan to willingly increase its position by 64%, even if it's acting as a conduit for client demand or as an app, it signals two things. Massive client demand. Their clients, from high net worth individuals to institutional funds, are demanding Bitcoin exposure through the safest, most regulated vehicle available, the spot ETF. JPM is simply meeting this overwhelming demand. Operational comfort and de-risking. The bank is now fully operational and comfortable with the custody, regulatory, and trading mechanics of holding and moving hundreds of millions of dollars worth of a Bitcoin-linked product. The form of fear and uncertainty surrounding crypto are being replaced by routine business operations. This isn't just about JPM buying Bitcoin, it's about JPM facilitating the purchase of Bitcoin for the world's most sophisticated capital. It represents a monumental shift from outright opposition to full-scale operational embrace. The 64% increase in holdings is the what, but to understand the why for 2025, we need to look at JPMorgan's own recent research notes. Because here's the real story: JPMorgan's analysts are now actively making a bullish case for Bitcoin, specifically comparing it to gold, and their numbers are eye-opening. The core of their argument revolves around volatility adjustment. For years, Bitcoin's price swings made it too risky for major institutional allocations, especially when compared to the relative stability of gold, the classic store of value. JPMorgan's team, led by strategist Nikolaos Panagurtzoglou, tracks the Bitcoin to gold volatility ratio. The volatility ratio. This ratio measures how much more risk capital Bitcoin requires compared to gold. Historically, this ratio was very high. The drop, according to their latest analysis, this ratio has significantly dropped, now sitting around 1.8. This means Bitcoin now only requires about 1.8 times more risk capital than gold. That's a huge improvement, making it far more palatable for conservative institutional portfolios. JPMorgan's analysts then use this improved volatility ratio to perform a mechanical exercise to determine Bitcoin's fair value, if it were to achieve parity with the private sector's investment in gold. The logic is simple. If Bitcoin acts as digital gold, and its volatility profile is converging with physical gold, then its market capitalization should eventually align on a risk-adjusted basis. Gold private investment market cap, roughly $3.5 trillion, excluding jewelry, central bank holdings. JPM's mechanical calculation, to reach parity with gold on a risk-adjusted basis, using the 1.8 volatility factor, JPMorgan estimates Bitcoin's market cap would have to grow by approximately 67%. This calculation leads to a massive, yet scientifically derived, price target. Based on this risk-adjusted parity model, JPMorgan's official forecast is predicting significant upside for Bitcoin over the next 6 to 12 months, leading into 2025. Let that sink in. This isn't a prediction from a maximalist YouTuber or a crypto-native hedge fund. This is the research department of the largest bank in America putting a $170,000 number on Bitcoin. Why the bullish shift now? This aggressive forecast is not based on pure speculation. It's tied to recent market dynamics that the analysts believe have cleared the path for growth. Checkmark deleveraging complete. The market saw a sharp, painful sell-off in previous months, which analysts believe has flushed out excess leverage from the futures market. This deleveraging phase, which one JPM analyst called the largest in crypto history, has reset the system. A cleaner market is a healthier market. Checkmark ETF flow confidence. The sustained, multi-billion-dollar inflows into the spot Bitcoin ETFs, like the IBIT JPM is now heavily involved in, proves that the demand is real and institutional. These are not speculative buyers. These are long-term asset managers making structural allocations. Checkmark macro tailwinds. JPMorgan's analysts also point to broader macroeconomic trends, including the eventual easing of monetary policy and potential interest rate cuts, which traditionally act as a tailwind for risk assets like Bitcoin. The narrative of non-bank liquidity expanding also supports risk on assets. JPMorgan is, in effect, saying that the price should be $170,000 based on its fundamental comparison to a traditional store of value, and the recent market correction has simply made the asset even more undervalued. They believe Bitcoin is currently trading at a $68,000 discount to its fair value. The institutional landscape is now a game of follow the leader, and JPMorgan's move is a massive signpost. When a bank of this size increases its operational exposure, it sends a clear message to all other hesitant, slower-moving institutions: the door is open, and the train is leaving the station. This is the ultimate stamp of legitimacy that the crypto world has been waiting for.